Ultimate wealth is found in wisdom alone.
All right. Hello, everyone. Welcome to our Tax Threshold 2025 planning meeting. This is probably the most important webinar that we do each year. So congratulations on participating. Hopefully you'll find it valuable, not just for this year, but potentially for years to come. Um, every year we go through the same type of data. So, and every year these thresholds change. So, but first I want to just introduce everybody here. So I'm not sure where they're at on my screen, but we've got George Luke, um, and then Grant Finter. Both are associate advisors here, and then Kim Rondo, who's the executive assistant. Thank you, Kim, for helping us get this organized and put together. So, and we also have Carrie Hoblet. So she's a part of the team as well. All right, let's jump right in. We'll get right to it. So, threshold, the magnitude or intensity that must be exceeded for a certain reaction, phenomenon, result, or condition to occur or be manifested. So, also comes from thresh, which means to rub, turn, stamp with your feet, knock, beat, or strike. So today we'll be describing the level to which you will be strucken, beaten, turned, stamped, knocked, etc. I always like this. Remember that the IRS spells theirs. So we're kind of talking mainly about these tax thresholds. Also, hopefully we can kind of turn this threshing floor into something that's going to be more meaningful in the future. Maybe we can find some fruit that will be established on the threshing floor.
Wouldn't
So
it be bread?
bread, a fruit, it's the fruit of the grain that's threshed.
Okay.
So yes.
Nice. Good.
All right, let's jump in. Oh,
Or jump out.
yeah. Sorry. Let's see. Can you guys still see this?
Mm-hmm.
Yep, same screen.
I think I must have clicked this writing pen. Huh. Okay, sorry. All right, so here's our outline for today. We're going to go over, the 2025 income tax rate schedules and changes. Just a reminder that we're not tax advisors, and this isn't meant to be personal advice. For personal advice, either consult your professional tax advisor or consult with us individually. Reach out to Kim to schedule a time. We're going to be going over the standard deduction, child tax credit, gift and estate tax exclusions and credits, education credits, deductions and distributions, tax deadlines. Most of those haven't changed. Retirement plan contribution limits. This is probably the most important one for our savers. Also the super catch-up, and what is that? Because that just came into effect this year. Social Security thresholds, provisional income brackets, FICA, Medicare tax, and then the Medicare premium thresholds. So let's start here. So this is the 2025 income tax rate schedule. So we're all familiar with these. Depends on if you're single, if you're married, filing jointly. Most of our clients are going to be in these two. We have maybe a few that might file as a head of household. But most clients are going to be single here or married filing jointly. These brackets haven't changed this year, so this is the same. The 10%, 12%, 22%, 24, 32, 35, and 37. Same for married filing jointly. These are tiered, so your first set of incomes taxed here, next tier, next tier. So a phrase you'll hear us say is your last dollar earned is taxed at 24% or 22%. And so it's important to know that these phase in over time, depending on how much you've earned.
A progressive tax, as we would call it. So not a lot of, some people hear about what tax bracket they've gotten into and they think that that is what all of their income is taxed at, which is inaccurate. So we want to keep in mind that the first level of income here is taxed at that 10%. And then once you surpass that, it's a cascading effect to the next percentage. So the effective rate is always lower than your top line.
That's right. Yep. Now, important to know, the Tax Cuts and Jobs Act, which applies for this year, that's 2025, will get adjusted. So if you're watching this in 2026 or beyond, these may have drastically changed because again, it either needs to be extended or changed. It's my opinion that they'll probably be very similar. There'll probably be some SALT tax deduction and some other things that may get adjusted. But as of right now, this is applicable only for 2025. Beyond that, we don't know. Also on this sheet is this tax rates on long-term capital gains and qualified dividends. So this is also very important to know. These two brackets are kind of siloed, but your long-term capital gains or your qualified dividend rate is affected by what your income is over on the other side. So if your AGI is high or your taxable income over here is X, Y, or Z, it's going to affect what rate you're going to pay on long-term capital gains. So long-term capital gains, what is that? So it's an asset that you've held for over 12 months, so to the day. So if you've held it for 1 year and a day, now you're in a long-term capital gain. So most of the time, the clients that we're going to have that this is going to apply to, certainly for qualified dividends, that's for clients that have a dividend that's paid from a company. The IRS, my understanding, they don't want you doubly taxed. So if the company's paid taxes when they distribute that dividend, it's also then taxed at this rate, which is the same as your long-term capital gains rate.
Mm-hmm.
So if you are now under these thresholds for taxable income, which is important to know, is a little bit different than AGI or adjusted gross income. So if your taxable income is below $48,350 for a single filer or $96,700 for a joint filer or $64,750 for head of household, you're in a 0% long-term capital gains rate on the federal side. Your state bracket, it also applies. So it's not 0% tax altogether, just on the federal side. In Oregon, which a lot of our clients are in Oregon, they do pay the their normal income rate on long-term capital gains. So, and then you break into the 15% up to $533,000. So if you're 48 to 533 single filer, you're at 15. Anything above that, you're at 20. For married filing jointly, it's 600,000, and then you're in a 20% bracket. If you have a lot of net investment income, you're also going to be taxed at additional 3.8% on that. If you're above these thresholds, those change a little bit. And then the exemption amount for the alternative minimum tax, you can see these thresholds also changed a little bit here. All right. Let's go on to, this is a state rate. So we have Oregon, and then Idaho is just a flat rate here, 5.695%. Oregon has a little bit of a phase in. I pulled this off the net, but 0 to 4,300 for single filers, or 0 to 8,600, you're at 4.75. So there is a little bit of a layering that goes in with an Oregon income tax. So something to know. Oregon's obviously much higher than Idaho. All right. Standard deduction and child tax credit. This is a big deal because effectively, this income is not taxed. Go ahead, Grant.
Yeah, I mean, the biggest number we want to look at here is, especially for the people that are married filing jointly, but is this $30,000 deduction, especially as it pertains to whether or not on your taxes you're claiming all these write-offs individually, itemizing, or not, because most of the time you're not going to be exceeding that number. So it's important to keep an eye on that. You may be wasting your time with some of the receipts at times. So if you don't think you're exceeding $30,000 on your standard deduction with your charitable gifts, then maybe you don't need to take care of that. And those numbers, just like with everything else in those tiers, decrease for single folks or for somebody that's single with a dependent, the head of household, a little bit higher.
Yeah.
Then, of course, there's if you have disabilities such as being blind, or you're blind and you're over 65, not married, not a surviving spouse, we're just layering this in. Neil, what would you add?
Yeah, this is quite nice. For most people, getting a $30,000 standard deduction, which is effectively income that's not included, in your federal tax rate, quite nice. So that keeps growing. That's becoming more and more significant. So that's important to know. Again, if you're over 65, you also get these credits here. Child tax credit, $2,000. These are this is a credit. One note on that: child tax credit that goes directly against tax liability as opposed to deduction. So the standard deduction just reduces your income, but your credit goes directly against the tax liability. And so that's a big deal. But so depending on where your income bracket is, that could be a larger value or a lesser value. If you're paying 50 cents on every dollar, that's effectively a $4,000 deduction. But if you're only paying 10 cents on every dollar, that's a lot more. It's like a $20,000 deduction, or, you'd have to have that much of a deduction to equal the same ultimate tax benefit. So, and then the income phase out begins now at $400,000 for a joint filer for the child tax credit. Yeah, big deal to know these numbers too, especially for your Grant mentioned the giving, which we have a lot of clients that don't give above their standard deduction. So there are some strategies that we're actually covering this month on ways to give to maximize your deductibility of that gift. All right, gift and state tax exclusion credits. So most common number that we are discussing with clients is this 19,000. Why is that? Because that's the amount you can give without having to file a tax form. It's also per social security number. This is a common question, meaning if I wanted to gift George money, I could give 19,000, Kim could give 19,000, Grant could give 19,000. Or more commonly, if I wanted to give my daughter a down payment, I could give 19 to her, 19 to her spouse. My wife could give 19 to her, 19 to her spouse. So per social security numbers, you can give quite a bit of money if you want to. Last year, this was 18,000. So it's nice to see that go up. So we don't have many non-citizen spouses, I don't think, as clients right now. But those thresholds also went up a little bit.
Neil, for the estate gift exclusion,
Yeah.
How does that relate? When does that change, or is that projected to change?
Yeah, good question. It does change. There was a year in 2010 that there was zero estate tax federally. They just didn't include any changes.
Oh,
so
for the day.
Yeah. So I mean, if you were alive in 2010, you could have paid no estate tax. But you just would have had to have died that year. But
I think I'm doing okay. I'll skip that.
Yeah, most people would, but just to say that it does change though. It was, much lower than during Obama administration, they raised it, and now it's been kind of indexing upwards. This is per individual too on the federal bracket only. This doesn't include state. So if you're in Oregon, we have $1 million exemption. So that's a really good question to ask, George, because otherwise you have two different estate taxes. You have the state estate tax or state death tax and the federal death tax. This is the federal number. which we have clients this applies to, but it's fewer. But with good planning, you can maximize this exemption because it's per individual, so you could potentially stack these with some good planning with a good estate plan. Same thing with Oregon, $1 million to $2 million with some good planning. But that is an important number to know, more so on the state side in Oregon than it is on the federal side.
Thanks.
Yeah. Anything else there that I missed, guys?
Not off the top of my head.
All right. Education credits, deductions, and distributions. So it's important to know these thresholds because, there's some things that we talked about with progressive taxation where you're it's not so much a bad thing to crest into the 24% bracket because it means that you earn that much money. But there are some things where you crest a threshold and it negatively impacts you immediately. And so these thresholds are really important to know. So these education credits, deductions, and distributions, or that child tax credit threshold can be really important to know. Let's say, for instance, which we talked about with somebody making $400,000, they no longer get the child tax credit. Well, if they made $399,999, they would have still got the child tax credit. And so the same thing applies here for the education. So when you cross these thresholds for joint filers, you no longer get this tax credit applied to your tax liability. And so it can be important to know, whether or not you go get that final job. If you're a contractor, now you're going to make $161,000 and you no longer get a $2,500 tax credit because you earn that much. Kind of important to know where these are. Lifetime learning credit is the same. Savings bond, interest tax-free if used for education. That also has a threshold here. Cloverdale, this isn't used as much anymore because 529 plans can be used for primary school, but that was the primary school education savings account. And then these thresholds haven't changed for 529 plan for kindergarten through 12, 10 grand a year for distribution. There is no income limit for making contributions or pulling money from these types of accounts. So anything on that, guys, I didn't cover or we should go into more?
The $10,000 distribution on the 529 plan for K through 12 education is per child or per social security number.
Yeah. Yep. All right. Tax deadlines, these are pretty much the same. Most of them that are going to apply to our clients are going to be fourth quarter estimates. Those were already due since we're doing this after January 15th. April 15th now is the tax filing deadline. That's where I believe it's still at to this day. Last day also to contribute to a Roth IRA or traditional IRA. So you can't do your IRA for 2024 after April 15th. But you can out to, if you file an extension, so it's tax filing plus extension for plans such as a SEP plan. This is the most common for us now, simplified employee pension plans. So important dates to know. Also, just the estimated taxes. If you're watching this, mark down June 16, September 15th for your estimates if you're self-employed. Okay, retirement plan contributions. So, George, we have some saver clients. Why don't you go through this?
Sure. You can kind of read at the top here, annual compensation used to determine contribution for most plans. If you're at that 350 limit or below, that would be something where this is a good opportunity to keep in mind that a lot of these plans are still open for you to take advantage of. So for a defined contribution plan, like a 401k or an IRA, you have for some of the IRA plans, but we'll focus on the 401k. For the 401k, you have a 70,000 per year limit. And that's the important thing to remember. That's a per year limit. You can't go above that, and that's from the employee side. Underneath that limit, you have these possibilities to give 23,000 is a normal amount that you can put in, up to the max of 70,000. And that's just a normal, you can contribute every year up to that normal 23,000 amount or more that you could put in. Between the years 60 and 63, I'm skipping 2 lines down just because it's a neat big opportunity. This is a super saver opportunity, which is great. You can put away 11,250 on top of that 23,000 and on top of this other zone that we'll talk about in a minute. But I want you to see that's a 4-year small opportunity zone where you can put in a lot of money that you can't normally put into these plans in addition to your normal contribution. So that can be a useful opportunity if you're earning in that age. The one that's in between that 23,500 and the 11,250 is the 7,500 amount, and that's for a catch up for ages 50 to 59 and then above 64. So you have this bump up in opportunity and then it goes down back to a pretty good opportunity. So putting those together, that can be, if you put those first 2 numbers, the 23,500 and the normal 7,500 together, that's 31,000 that you could be saving every year. That's a possibility. And then you have that employee contribution that you have, and then that your employer contribution on top of that employee contribution has to equal 70,000. So that's the total amount it all has to equal.
Maximum.
Yeah. So thank you for saying that clearly. The additional 11,250 then would bump that employee contribution up for that small zone of ages 60 to 63, up to 42,250 that you as an employee can put into that plan. So 70,000 total contributions, employee. Inside of that is this great opportunity for you as an employee to put in a large amount of money, and it goes up during certain zones.
Yeah, and depending upon your plan, that could be pre-tax or it could be a Roth 401k after tax monies.
That's a great point.
Yep. And then we have the simple plan. So these are all defined contribution plans, your 401k, 403b, 457, simple IRA. These are all defined by the amount that you can contribute as a max. Also, your SEP IRA maxes out at 70,000. One other note on the annual compensation used to determine contribution plans, the maximum here is 350. So if you're earning above that, you can still obviously participate in your plan. It just means that compensation above that is not going to be included for calculations. So one common question we get actually is, can I have multiple 401k plans at the same time? Maybe you have different employment opportunities. You work a little bit here, a little bit there. You can, but they want to limit your total contributions from employee and employer to 70,000. So, yeah. All right, IRA contributions. So this is still for our saver clients, those that are building wealth, kind of that wealth accumulation phase. Grant, we have a lot of clients that have these IRAs, obviously. Why don't you go through these thresholds?
Yeah, I mean, a lot of these were established for those that didn't have a pension plan or a 401k plan available to them. Obviously, the contribution limits are lower, and sometimes there are limits for the income that you can have before there's a phase out. But generally, you're looking at $7,000. And there is a small catch-up feature on each one of them to help you get a little bit more in. Depending upon your tax bracket, that's why we if you're in a lower tax bracket, we think the Roth is a great idea, because then you're locking in no taxes on that money growing tax deferred for the rest of your life, especially if you're at the beginning of your career and you're in a lower tax bracket. It's a great tool. Then there's the flip side of that coin with Roth conversions. If you've already retired and all of a sudden your tax bracket has dropped down much lower than it was before, maybe that's a good opportunity for you to pay and convert those into a Roth, pay a little bit of tax at a much lower rate and save yourself money in the long run and let it grow for a good period of time.
Yeah. Couple of things that can apply to people are this, that if they or their spouse don't have a retirement plan, they can make a traditional IRA contribution, even if they earn above these, and have that be fully deductible, but only if they don't have a retirement plan available. If they do, then you have much lower limits on the deductibility of that traditional. Although most of the time we're not going to go there, we're going to look right to the Roth. They still apply. So this is the important number, really, this 236. If you've earned above that, then you start to phase out of being able to do your Roth IRA in addition to your 401k. So you can do this in addition to. Yeah. All right. Health savings accounts. We're big fans of health savings accounts. These thresholds also go up. So if you got an HSA, you got a health savings account. Depending on if you have an individual plan or a family plan, there's also a age 55. This is a little nuance. Rather than 50 for the 401k, at 55, you got a little catch up to put into your individual or family plan. But if you have that, it's prudent to increase your contribution to try to get to this maximum if you have the capacity to do that. One thing that on all these types of plans, or 401k, 403b, etc., they're payroll deductions. So we're doing this at the beginning of the year, letting people know where they're at, so that they're not, in November or December trying to force in and get their last little bit, amount, basically contribute their entire salary to their 401k. It's better to trickle it in, right, throughout the whole year. So increase these contributions now, rather than trying to play that game at the end of the year, because you can't just take money out of your pocket and put it in. It's got to be payroll deduction. So, Grant, thoughts on that?
Well, not necessarily that last point, but just the HSA in general is the triple benefit to it. It's coming out pre-tax, lowering, your overall AGI, and then as long as you're using it on health expenses, which all of us are going to have at one point or another, it can continue to grow tax deferred and be used tax free in the end. So that's a huge benefit. Nothing else exists like it, and sooner or later you're going to need it. One thing we do recommend for folks, there can be an investment component inside this, but in general, if you have an HSA, you have a high deductible plan in the first place. So the suggestion would be, okay, go ahead and set aside in cash the amount of your deductible, whereas the rest of it could be invested to grow.
Yep, that's exactly right. The other threshold that changes is the Medicare deductibles. So your Medicare deductibles go up a little bit each year. This is the amount that you have to pay out of pocket for various services for your Medicare Part B and Part A. Those go up a little bit each year. So if you're paying for the deductible out of pocket, expect to pay a little bit more. Social Security thresholds for those that are taking Social Security now. Many folks know, as we go over this, for their planning, we're talking about, especially those that are approaching retirement soon, a couple of really important numbers that change every year. First off is this number here, this 23,400. So this is the amount that you can earn without, bless you, Kim. This is the amount that you can earn without having it affect your Social Security. So oftentimes, people are wondering, okay, if I'm taking Social Security already, how much can I earn? So you can earn up to this without, above that is $1 for every $2 you earn. So important to know if you're taking Social Security at 62, 63, 64. Most clients now that this is becoming applicable for will hit full retirement age. That's the FRA age here at 67. Yep. So the year you turn 67, or the year that you turn full retirement age, you can earn $62,160. So these two thresholds go up each year. Important to know if you've taken Social Security early. We generally don't recommend, that, but just depends. Everybody's situation is a little bit different.
Yeah, some clients we have will retire from one job early, but not feel like they want to completely not work anymore and have some other sort of part-time job. And, this 23,400 number is pretty important so that they aren't wasting their efforts. They got to make sure that they aren't going to make more than that, or one out of every $2 is going to be clawed back through Social Security.
Right. That's right. So, sometimes people think these tax thresholds only apply to the very wealthy, but they definitely apply to our clients that are, living more constraint. Let's say it like that. Doesn't mean a great life, but just under a little bit more of a budget. And so this can be very important too. So knowing where these Social Security thresholds are, which change a little bit each year, because if your provisional income, which is defined here as adjusted gross income, not including Social Security, so it's other things, not Social Security, plus any tax exempt interest. Most clients aren't going to have tax exempt interests that are on Social Security primarily, plus 50% of the Social Security benefit. If that total amount for their income for married filing jointly or single is above or in these ranges, this is the amount that's applied to your federal taxable income. Doesn't mean that you're taxed at this rate. It just means that that amount is included in taxable income. So important to know these thresholds if you're, even if you're living very constrained life, because it can, save a lot of money to be under a different threshold here.
One just suggestion, since this is part of the sheet that we send out to a lot of people and they may not understand FRA, full retirement age, as a acronym, maybe we could put in the age limits here for each of them, less than or at 67 or above 67. That might be a good item to add to the sheet later.
Yeah. It used to be like 66 and 8 months or 66 and 10 months. We still have some clients that have waited that still have that applicable, but most people now are going to be 67. That's when we think about it for our age, Kim, you as well, be 67 is when you reach full retirement age. Yeah.
I guess you have a few more years with me, don't you?
So I hope so. Yeah. Well, you never know. Maybe you never know. Well, so Social Security thresholds for those that are still working. This can be important for those that are, paying quite a bit in FICA tax. That's 6.2. And then you have a Medicare tax on top of that. So your employer pays this, and then employee pays this. So 12.4% on the FICA tax until you've surpassed this limit. So, some people we have that are maybe making 200,000 that last, November, December check don't include the FICA because they filled the bucket already. So, nothing we can do to control these, but just knowing where these thresholds are can be helpful. Okay. Medicare. Yeah, go ahead, George.
Sorry, Neil. This came up yesterday with someone, and it was on my mind when you were saying the FICA tax. Could you briefly, if there's business owners that are thinking about tax savings, how does that interact with FICA? Like, what should they be thinking about?
Some of this has to do with entity structure. I'd really encourage somebody to discuss with their tax professional, like what reasonable wage is if they're an S corp.
If they have employees or not, that could also majorly factor into it, whether they're doing a SEP.
Yeah.
Because half of that FICA could be avoided as a contribution, correct?
Yeah, that's correct. Yeah. So that does, it also plays into, if they are what Grant was bringing up, SEP, simplified employee pension for the self-employed, specific type of retirement plan. If that's an employer contribution rather than employee contribution, which doesn't have FICA tax on it. But there's not a lot of planning moves to do here besides, there can be some, if you're setting your wage and if you set your wage below 176, 100, then you're also not going to get your full Social Security benefit. The internal rate of return on Social Security is pretty dismal. It's pretty small. If you compare it to investing the money that you would have paid in FICA from the employer-employee side, the amount that equals can be enormous, if even getting a modest return. But so if you set your wage below 176 as an S corp, then you're not going to be getting your full Social Security benefit. You better save that elsewhere, though, because that's the downside.
Great.
We all have a propensity to spend the money that we that we weren't forced to save through FICA. So, yeah.
Great. Thank you.
Okay, Medicare premium thresholds. This applies, to those that are 63 and above. Why do I say 63?
Because it's in arrears. So when you end up taking Medicare, they look at the prior 2 tax years to see what kind of income level you achieved.
Yeah, that's right. Yeah, because most of us, if we're filing taxes plus extension, if we're not getting our 2024s done till October, or maybe a little even, October 15th, if it's an extension, they want to know what incomes have come in to set those Medicare premium thresholds. So they look 2 years back to know for that next year what it's going to be. So this is the 2023 income number. So if your 2023 income was in these ranges for single and joint, this would be what your Medicare Part B and your Part D premiums would be. So if it's above that, you pay a bit more. This is per filer. So it can be, and this is one of these true thresholds as well. So if you earned 12,000, $212,001, you crossed into this threshold. Boom. Now you're paying much more for your Medicare premium. So,
which, this ties into what we were talking about earlier on the 401k or entity sponsored plans, where if you are getting close to retirement age and you've got the option to be a saver and do the extra pre-tax saving to bring down your adjusted gross income, that could come in really handy if you're close to one of these thresholds.
That's right. Yep. That's right. Yep. All right. So just the main takeaways, these are the ones that apply to most of our clients, just real quick. Most of the tax thresholds have changed. So if you're trying to max things out, you might have to adjust your percentages up to include those changes. 12% brackets higher, so it's at 22. All the brackets are slightly higher. And then, consider capital gain harvesting or Roth conversions up to those thresholds. If you're in that super catch-up age, consider, as Grant mentioned, how it might apply to your Medicare premium 2 years out. Medicare premium threshold and Roth IRA conversions. Some of those, if you're going to convert, keep in mind the Medicare premium threshold. If you're going to go into that 24% bracket. Maximums for 401ks, 403bs, etc. HSAs have all gone up. IRA, Roth IRA income limits, that's in addition to 401k. Those income thresholds for being able to do Roth have also gone up. We talked about the Social Security cost of living adjustment. We talked about that. And then, there still is a decent inflation, and indexing for Social Security and other types of pension plans. So if you're trying to figure out what your annual income is this year, make sure you add in the indexing for inflation. Like Social Security, it's going up a little bit. Other forms may also go up as well. Yeah, Social Security cost of living adjustment this year is 2.5%. Last year was 3.2. So, yeah.
Well, a couple of questions here, Neil.
Yep.
How did the Medicare premium change from last year?
Medicare premium threshold
Yeah,
change.
yeah, how did it?
So obviously it's a little bit higher. Let me see if I can find this slide. So these went up. I think this was 206 last year. Now it's 212. Yeah, I think that question though, say for instance, for planning decisions this year, we don't know what next year, the 2020, this year's, excuse me, what it will be when we go into 2026, because there's going to be the 2024 taxes are going to be used for 2026. And we don't know for 2027, which will be this year's income tax return. We don't know what it will be. It'll be somewhere higher than 212. But last year was 206. So what is that? Roughly a 3% increase on the threshold. So good question. Any other questions, Kim?
Yeah, what are the most important soon to retire thresholds to know for 2025?
Yeah, so for those that are soon to retire, now we kind of have like 3 different categories. We have kind of like our savers, our like soon to retire, and then our already retired. So let's talk about that first one, the still saving, wealth accumulation. Actually, George, you're kind of that category. You and I talk a lot about, what would you say are the main takeaways for that, wealth accumulator client?
Your Grant had mentioned earlier, your HSA is a great opportunity to be using at work because of the triple tax advantage that he had gone through earlier. Your IRAs, your IRAs, as we talked through here, as Grant talked through there, that's another opportunity for you. Your 401k is going to be in order. It's going to be your HSA because of that triple tax advantage. Your 401k matching, the matching contributions. You're going to want to kind of put those 2 things together and think ahead if you have those available to you, and take advantage of the free money. And then take advantage, if you're in one of these ranges that we chatted about earlier, for accelerated contributions. So the catch-up provisions for 50 and above, and then for the special super saver provision at in 60 to 63, those would be some additional things to consider as you're accumulating wealth.
Yeah. George, you bring about a good point that I don't think we singled out about the 401k is pretty much all these plans now have a mandated matching to be a safe harbor plan. So for most folks, that's going to mean somewhere around 4% overall. So it's important throughout the year, if you have a pretty balanced income, to strategically plan to max it out while also maxing your employee contribution, because no one else is going to give you free money.
Yeah. Good ROI on a match for sure.
Mm-hmm.
Kim, any other questions there, or should we go to the kind of the pre-retiree?
Yeah, you can finish. Yeah, why not? Let's just go ahead and finish that discussion. Perfect.
Yeah, so Grant, I know you and I mean, we have a lot of these type of questions that are just, about maybe 5 to 10 years out to retirement. What thresholds do you think are most applicable to them?
I'd say the 401k stuff, that's first and foremost. Yeah, I mean, well, we talk about all the time, number one indicator of success in retirement is savings rate, even ahead of asset allocation. So making sure that through plans like this, sometimes that have a match, which is great, but that we're in total getting 15% of our income saved, 20% if we're feeling frisky, that let's be overachievers.
I'll feel like that.
Yeah, that's great.
Yeah, I think also, the super saver provision, for those that are kind of pre-retired, maybe they're 60, 62 and they're thinking, 65 is still my target retirement date. Being able to utilize this super saver provision will also affect their Medicare premium because it's going to bring down your income this year if you're 63 or turning 63 for that year that you claim for Medicare. So it can be kind of nuanced thing to think, oh yeah, I'll bring my income down further so that my Medicare premium is a little lower for 2027. So kind of interesting how these thresholds this year apply to those items in the future. So the last thing we might talk about. Oh, go ahead, Ken. We have a
I
question.
said, thank you, team.
Yes.
You're welcome.
So the last thing I wanted to maybe just touch on is those that are already in retirement. So some of the thresholds that are there. So a couple of things. We've talked about this in the past. I'm going to scroll down to the Secure 2.0. They pushed out the RMD age to 73. It may even get pushed out further. We'll see. But that's expected to happen. We've covered some of these changes that have happened in 2003, 2004. There's a number of them in 2005. So that's where we're at now with this annual catch-up, the super catch-up. Also, auto enrollment for certain new employer retirement plans is going to be a requirement. But I wanted to back up and talk about a couple of things that were implemented in the past. And this kind of relates to our existing retired clients. Is that they allowed for a contribution to what's called a charitable remainder unit trust up to 50,000 that came into effect. That could be a discussion point. Not everybody that would apply to, but it could be something to keep your eyes on. QCD amounts began to index for inflation in 2024. So that means they set a cap at this at 100,000 annually. So if you're lucky enough to have $100,000 RMD or more, you can QCD that amount annually, and they'll start to index that for inflation. Also, this year is the first year, so next year we should see all the catch-up provisions, the $1,000 for IRAs, etc., also begin to index, which they haven't done. $1,000 is just not that much anymore. It's not what it was in 2020, 2001 when it was established. So they've kind of finally began to start those. But I guess to talk about for our retirees, those that are already retired for required minimum distribution age 73, and the ability to QCD that out, that at maximum will also begin to index for inflation. So there's a number of other things, guys. I mean, we're not going to cover the full breadth of planning considerations for our retirees too. That those Medicare premium thresholds that would apply to our Roth conversion clients, those that are retired soon, like recently retired. I would say those thresholds for Roth conversion Medicare premium also important to know. So,
thank you, Neil.
Any other questions, Ken, we have, or?
Nope, that's it. You guys are doing a great job.
All right. Well, thanks, everyone. Thanks for joining us. If you have any questions, feel free to schedule with George, Grant, or I to go into more depth. We'll see you on the next one.
Okay, you can always call me. Bye.